All right, in this lesson, we're going to show you what the journal entry would look like for an inventory purchase and just, again, reiterate what we've been talking about when we purchase inventory for our company. So let's get started here. From this point forward, you're going to be using the perpetual inventory system, and at least until the next section. So from this point on, just think perpetual inventory system. What is perpetual inventory system? Perpetual inventory system is the system in which we continuously update our inventory and our cost of goods sold numbers. So that's what you're going to think about going forward. And then when we get to section 7, we may be doing things on the perpetual side, but periodic side. So perpetual inventory system, just think we're continuously doing it. And from this point on, that's the method we're going to be using. Now, remember that this system revolves around the idea that inventory numbers are kept up to date. Transactions are completed in real time for inventory and the cost of goods sold amount. As a review, we know that when we buy inventory from our vendors, the cost of that inventory will go from the vendor to our inventory account. We will debit inventory and credit, well, you'll see in a minute. And then from there, we're going to move it from inventory to cost of goods sold when we actually sell it. So if we don't sell it, we don't move it. Okay, so it stays in inventory. Now, understanding how this all works, let's take a look at what the purchase entry would look like. So you are the company purchasing inventory from a vendor. What does that entry look like on our books? So when a company purchases inventory, the inventory is not an expense until we sell it because of the cost principle and the matching principle. Therefore, when we buy inventory, the cost of that inventory is booked into an account, in an asset account called inventory. So we're going to book it to inventory. So here's kind of an example of how we do that. Assume that company A purchased $535,000 worth of inventory from their vendor A, on account. Prepare the journal entry for the purchase of inventory. So we purchased $535,000 worth of inventory. And again, we are assuming that they've already delivered $535,000 worth of inventory here. So if that is the case, we will debit the inventory account because we're receiving inventory. Inventory is an asset. Increases in asset are debits to our books. So inventory debits $535, and then we are going to credit how we paid for it. Well, we didn't use cash because this problem didn't say cash. Instead, it was on account. Now, we said that on account could either mean accounts payable or receivable, and we have to think about the context of this question. Well, since we bought it, it would probably mean that we owe it. If we owe it, it would be an accounts payable. So we're going to credit accounts payable for $535,000. So whenever we make a purchase, this would be our entry or close to it. We're going to debit inventory and then credit how we paid for it. In this case, it was on account, so we're going to credit accounts payable. If it was in cash, we would credit cash. Now, taking a look how this would affect the T account, here is our entry. For our T account, we would debit this inventory by $535. So this number transfers to there, which is exactly what I showed you at the beginning of this lesson, where we book it to the left side of the inventory. And then once we sell it, we're going to move it from here in the inventory by way of a credit to our cost of goods sold by way of a debit. Okay, so that is what that would look like. Now, just as an extra exercise here, what would the entry be later on when we pay our inventory off? We pay our bills. Well, we did credit accounts payable. If we pay it off, we reverse it. So we're going to reverse the accounts payable here by debiting. And how did we pay for it? Well, there really is only one way to pay it, and that is through cash. So we are going to reduce our cash balance. A reduction in cash balance is a credit to cash. and that would be our entry. So again, this is not what we're trying to learn here, but I want you to kind of conceptually think about it through on how we buy inventory. Typically, we buy inventory on account, and then later on, we're going to need to pay for that inventory later on. Now notice, when I pay the inventory, I still don't book the expense. All I'm doing is I'm reversing the liability, and then I'm taking the cash to pay it. A lot of students think that when they pay it, it is an expense. It's not an expense until we sell it. Or sometimes when we say, what would the entry be for the payment of the inventory? They'll debit inventory again and credit cash. That's not what we're supposed to do. We're just supposed to reverse the liability with the cash that we use to pay that bill. So that's kind of just a review and to help you better understand the logic of what goes on when we buy inventory. So that is a look at inventory purchases and what the entry would look like from a financial accounting standpoint. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.